Yes, a very good evening to all our friends right here. Welcome down to the Geylang Serai Virtual Community Center. My name is Hui Jie, and today is actually the fourth series of the Wisdom Eye on Business Money Mastery Show. And right here for today itself is actually a time that we are looking into the more serious stuff in terms of investment and also the investing journey on how we can kickstart this entire journey from scratch. Okay, so right here for today itself, before we kickstart the program, actually would like to also give you some updates on the series number 3 that we were having. For those who have already followed on this program itself, you must know that in the past 3 series itself, we were talking about things like the cryptocurrency. And for those who follow on the second speaker, where we talk about Dogecoin on a Sunday, and in fact, it's true enough, on the next following Saturday itself, we actually have a very high spike of up to 70 cents right here for the Dogecoin that was actually being carried by the very famous Elon Musk. So at the Saturday live show itself, right, basically when we first featured about this program, which is called the Dogecoin itself, on Sunday, we were talking about things like having the Dogecoin at about 25 cents only. But on 1 week itself, wow, true enough, actually our speaker is so good that he predicted and he also mentioned that this is going to be a spike. And right there at the Saturday itself, we do have a spike on the Saturday Night Live show brought to you by the Elon Musk. And yes, Dogecoin did went to the moon and to the sun. Okay, so the staging here, if you'd like to find out more about quality content, I would say that right here for Money Mastery Show, we'd like to bring you the latest news and at the same time, the best information on how you can actually invest smarter and of course also invest better as well to get yourself an early retirement. So with that right now, let's pan the screen to our slide itself. We will kickstart the program proper for today. So this program is actually brought to you by the Wisma Geylang Serai, and of course right here hosting the studio itself at the building is a very nice building right here where we are also marching towards almost the Hari Raya weekend and also the public holidays and all that. So right here for today itself, Money Mastery Show would like to showcase to you on the investing journey. And of course this program actually aims to create awareness to the public to be future ready while Singapore actually march towards its mission to be Asia's business and financial hub. So to better outreach to the masses, it will also be a series of dialogue where it actually comes with a twist of the informal and interactive and of course infotainment to cover local plus international business and financial news. So with that right here, we'd like to also bring to you the disclaimer for today as well. So this program is actually for information purpose only and should not be captured and also construct as a recommendation for purchase, sales, subscribe or participate in any services or products. So before acting on the information provided, please consider that if it suits your objective and risk tolerance. And if you need professional advice, do consult the MAS registered of representative list. If you need more assistance, do feel free to contact us because we can refer a list of quality and qualified professionals for your consideration. And in fact, for today itself, right, we would like to also share with you that we do have the lucky winning pricing for you to walk away with. It's actually a $10 NTUC voucher for 3 lucky winners. Okay, so just a quick flash, we do have some feedbacks where my friend says that, oh, you know, we can't capture the questions, we do not know where to find the answers and stuff like that as well. So right now for today itself, a special freebie for all our friends since Raya is around the corner. If you'd like to win yourself a $10 NTUC voucher, do take a look at the next 3 questions that we are flashing to you right here. So for today, the first quiz question itself is actually, what is the best region to invest for 2021? Okay, so this is actually the first question for today. And the second question for today itself is, how do you best protect yourself from volatility while investing? Next one here that we have for the question number 1 again. All right, that's actually a wrong one. Number 3. Okay, so number 3, question number 3 is, what can you invest through Endowus? Okay, so in fact today itself, right, is actually a very special time where we actually have a very special guest right here that's from Endowus, and she's none other than Wei Mei Tan, and we just realized that actually our name is like just opposite each other. Later we'll talk about it. Anyway, Wei Mei is actually a CFA and a CAIA and CA, where she now actually serves as the board members and of course as the management of Endowus itself. But prior to that, she has been in many places, as you can see right here, as the managing director and of course the global co-head advisory and investment solutions for Deutsche Bank, and also the head of portfolio solutions APAC for Credit Suisse, and head of the mandate specialist APAC for UBS, and investment banking for JPMorgan and Credit Suisse, and of course asset management for Temasek and Fullerton. And none other than that as well, she also has some stint in the education agencies and of course the institution as well, where she served with the Harvard Business School and of course NTU itself. Okay, and with that, without further ado, let's pan our screen to our guest right here for today, Miss Tan, Wei Mei.
Hi, good evening, Wendy. Great pleasure to be here tonight.
Yeah. Actually, we were talking about our Chinese name, right? My name is Mei Hui, and you are?
Wei Mei. So we have the exact same character, and in fact, it's just going to be flipping over our characters, and we actually would sound rather identical.
Yeah,
Such
hopefully.
a coincidence.
But I also hope that I can be as smart as you.
You already are.
Really?
Yes.
I'm trying. Actually, I was telling, Hui Mei itself just now that I basically just have a very short stint in finance. It's mainly through like education and all that. Not exactly practicing, but I realized that actually you came from an education background and later on went into financial institutions. So how did this whole journey happen to you?
I think to be fair, I did focus a lot on the academic front in the early part of my career. But having said that, I think it was also after being in the business for around 18 years that I decided to do more of a executive MBA at Harvard. And over the course of the last year, I've also been involved with NTU as a adjunct lecturer focusing on the Career Foundations program for the undergraduates in the Nanyang Business School. So I certainly have a strong passion for education, but at the same time, over the last 20 years, I've also been involved in asset management, investment banking, as well as private banking. So right now at Endowus, I'm the Chief Advisory Officer. I focus on helping our clients build up their investment portfolio. First of all, by selecting the best-in-class fund managers that we have in the industry. After that, we would curate an investment portfolio that's suitable for their needs. And thereafter, we'll help them in terms of the monitoring as well as the ongoing updates that are required. So for many of our clients today, they have got different needs. Some of them focus more on general wealth accumulation. Others are more focused on wealth preservation. And we do have solutions that can also transcend into cash management. In fact, I think what's really interesting would be ESG. I think this is a buzzword that you hear quite a fair bit.
Yeah.
Environmental, social, as well as governance. And many of the investment solutions today do have an ESG angle. And I'm proud to say that for Endowus, we are the first to be able to launch an ESG portfolio for our clients.
Yeah.
And for our friends out there who may not know about Endowus, we are actually the first and only digital advisor in Singapore that can help you cover CPF, SRS, as well as your cash investments. So do check us out. I think we definitely are at the forefront of providing access in terms of institutional share classes of funds at the lowest cost possible. And it's very easy to start an account. You start off at $1,000.
Yeah, so Hui Mei, actually, you were saying that you are the first in ESG. I do admit that. But I think the best breakthrough and things that I was actually pretty shocked is Endowus actually managed to convince CPF board to allow you to invest the public money into S&P 500. That is indeed like, wow, eye-opening. How do you guys do that?
I think it was certainly a long journey for us in terms of building up our tech stack and our platform as well as interface in order to gain the trust of the CPF board, and at the same time also be ensuring that we are adding on more solutions that can help the general public to be more efficient when it comes to investing their CPF. So I would say that wasn't easy, but now that we have been able to solve the problem, I think we can only encourage more of our Singaporeans to look at investing CPF rather than keeping them literally as cash in the portfolio.
Okay, I think I need to add on one thing. It's not only Singaporeans, it's the PRs as well.
Oh yes, absolutely. Anyone who's resident in Singapore with a CPF account.
Yeah, with a CPF account and all that. Actually, there's another thing that really catch my eyes right on this slide itself is actually SoftBank. So how did this whole thing happen? I mean, I know that you guys are a very young startup, less than 5 years, and having SoftBank to actually inject 20 over million, right? That is indeed, wow, eye-opening. And how did that journey actually started? Is it because of your board members, your founders and all that? Or is that something that is in line in terms of things like robo-advisory in this marketplace?
So, Hui Jie, as you rightly pointed out, Endowus is a relatively young firm. We started in 2017, so we are in our 4th year. And we were very proud to be able to win a number of awards, including being the Rising Star for FinTech and also receiving a Wealth Tech Award for 2021. So just a couple of weeks ago, we actually had that new accolade. So to your question as to why we were able to attract external investors, I think they truly believe in our story. So for Lightspeed as well as SoftBank, they are our Series A investors. Prior to this, the company was entirely funded by the employees as well as the founders. And it's the first time that we are welcoming external investors. And we do believe that we are now positioned for the next stage of growth. And we are accelerating our trajectory to become the biggest digital advisor in Singapore, which is why it is very timely. And having the likes of Lightspeed as well as SoftBank coming in to help us in making progress towards expanding our investor base, I think it's something that we're very excited about.
Yeah, I'm pretty excited as well. And to be frank, I have an account with Endowus.
Oh, thank you.
Yes. And that is actually looking at a very, very high return and stuff like that. But right here for today, I think our topic is mainly talking about investing 101, right? So why do we talk about investing 101? Is it because a lot of people are not very sure how to kickstart? There's always like a fear factor, right? I remember when I first started investing, I was quite gung-ho, I was actually just like 21 years old back then, many years back anyway. I will not reveal my age anyway. So I kind of have like a salary and I kind of park a certain sum. I learned about this thing called the 50-30-20 rule, where I actually do some part of my savings and investment into the fund supermarket. That was back then many, many years ago. That was like 10 over years ago that I actually did that. And I was pretty amazed by returns and stuff. So what is investing 101 to you?
I think from my perspective, investing very much allow an individual to focus on growing their wealth. I think it's part of the journey to enable us to certainly live better today and help us in terms of enjoying the little luxuries and hobbies that we may have. But at the same time, this is also about living better tomorrow and towards retirement. And this is very much our objective when it comes to helping the general public look at how to invest and also making sure that it's possible to take that first step, because there's always inertia. And I'm glad to hear that you started at 21, because not many people are starting out as early as you have done.
Yeah,
so I think that's credible.
Sure, because I studied finance and economics. Yeah, so that's like kind of part of our blood inside the blood, although we are not like practicing it.
So it's your DNA.
It's kind of a DNA thing, and nowadays, I'm always managing monies, finances, and all that. I think that is something that everyone needs to learn, yeah? And I'm actually pretty glad because nowadays, even in school, we are talking about things like financial literacy. I finally see that parents and all that are pretty much open into talking about investment, talking about insurance. Not like in the past, wow, an agent is coming, pick up your phone kind of stuff, yeah? All right, yeah. So with that right here for today, there are some disclaimer that you would like to share with us, right? Okay, yeah. So, wow, very small.
Yeah, I think this is our standard disclaimer, but I think indeed as we go through some of the information, do refer to what's stated here. And certainly this is not part of advice customized for an individual.
Yeah, so basically just now Wei Mei also shared with me that Endowus do provide some advisory services. So there's actually a disclaimer here. It's only limited towards CPF type of investment, not towards things like insurance and what else, Wei Mei?
So we don't actually provide a full suite of wealth planning. We're not in the insurance business at this juncture. So our focus is very much on looking at fund solutions. So typically this would be mutual funds. And this would be where we are advocating that many of our core portfolios for general accumulations, be it using cash, CPF, or SRS, will be something that I think our investors should continue to build up, even if you're looking at regularly saving up just to put the money to work and for the money to work harder.
Yeah, correct. So we will talk about the 50, 30, 20 rules and all that in our subsequent series. But right here for the day itself, if you do have any questions, feel free to like and share our page itself. And also at the same time, you can comment in the comment box. If you feel that investing is something a little bit more intimate, you want to keep it into more private, feel free to drop us an email as well. And Endowus team or us will actually respond to you in 3 working days' time. All right? So let's start with our journey for today. So how should we actually think about our wealth and investing? So wealth is something that I know that in school back then they teach us like you have to preserve wealth, you have to grow wealth. So what is this preserve and grow all about?
I think that's a very good question, Hui Jie.
Yeah.
And I think when it comes to thinking about wealth and investing, they of course go hand in hand, right? But I think perhaps let's just take a step back and look at how our Singaporean population is looking at this topic. And then I'll add my comments as to what we can do as we become more interested as well as more educated on this topic.
Sure.
So over here, I wanted to share a chart. If we are looking at our demographics today, we do have about 1/3 of our population that's not investing at all. So literally you might see people perhaps still keeping some of their money just in bank accounts. Others could be keeping them at home. I hope nothing is under your pillow for that matter.
Not pillow, but bank account.
Okay. And certainly we also have around another 1/3 that feels that their investments are not performing up to their targets or even their expectations, right? So a lot of times you could have invested into something, but after that you realize that, oh, okay, it's not quite what I think I should be getting in terms of returns. And there is also a part of our population, around 27%, fairly sizable, that's looking at more speculative investments. I would consider this to be a bit more of a gamble. You're looking for some quick gains and upside. So to be fair, I haven't really seen our general public looking at a very concise plan on how they want to go about growing their wealth. So this is where we stand today. And maybe if we moved on to the next page, I can share with you that I think a lot of times we think only about cash, right? Because CPF and SRS, we think that it is locked away. It's something that you're going to get only on retirement. And therefore, let's not think about it. It's just keep it one side. However, I think we should be conscious that if we are able to invest all 3 pillars of wealth equally, we are going to be much better when it comes to our retirement. And to that extent, we do encourage that investors look at growing their CPF above and beyond the 2.5% that they could get in the ordinary account.
Yep.
And also for SRS, it's important to make sure that you are growing it, because the likelihood that you're going to be withdrawing it, even if you can right now in the interim, is unlikely to happen. You'll probably only be withdrawing it far down the road when it's time for you to take a break, to retire, and enjoy the finer things in life. So therefore, it is something that I think consciously we need to remember that there are actually 3 pillars of wealth and not just the first one, which is cash.
Yeah, and I also know that in the business world, right, a lot of people will say things like asset allocation. There are actually like 5 pillars of asset allocation. We talk about things like stocks. We talk about REITs, which is real estate investment trust. For those who might be asking me, hey, I thought this series we are talking about REITs. Yeah, it's coming soon. We're gonna set the ground right first for investment 101. And REITs is actually also another alternative form that a lot of Singaporeans are looking into because it's very heavily depending on asset base. A lot of us always think about cash. Second one, real estate. Why? Because can see, right? Can touch. Yeah, so these are the things and blind spot that a lot of people are actually stuck at. But the new generations are moving to the next step, which because we're looking into REITs type, which is you're buying a property, but it's on a virtual thing. It's actually just numbers, okay? And you can trade it anytime. And the next thing will be things like commodities and also the bonds as well. So we didn't really touch about bonds. I think for Endowus, you have a very special way of doing the bonds, right?
So for us, we pick the best-in-class mutual funds in the market with names that I think many of you will be familiar with. The likes of Fullerton, Lion Global, UOB Asset Management, and also the global players, other than the Singapore players, the likes of BlackRock, First Sentier, Wellington. So I think these are definitely managers who are very specialized and at the same time are managing a lot of assets. So for us, be it in terms of equities or bonds, which would be fixed income as an asset class, we advocate that you as an investor would be allocating towards this kind of assets via mutual fund managers. Because we do believe that these are managers who are very experienced, they are in the market, they are watching the market for you, they are doing the stock selection or even the bond selection. So there's no need for you to be actively involved. They are active on your behalf, and that's where we would advocate the value added.
Okay, that's interesting. And let's take a look at the next slide. I noticed that we actually have the money in your bucket. So what is this principle all about?
So Huijie, earlier you touched on different asset classes. So over here we have given a very high level example of money market, fixed income, and also stocks. Money market will be more similar to cash. But you could use a fund, like a money market fund, to get a return that is often higher than what you get in terms of deposits in the bank. And over here, I wanted to share with you that in terms of time horizon, especially as you have a longer time horizon, what's going to happen is that you can afford to take on a bit more risk. And as a consequence, you would also be able to invest into more stocks compared to buying more into fixed income, which are going to be bonds. So the way we would allocate it would be, first of all, it's always important to make sure that you're saving for a rainy day, right? You need to have an emergency fund. An emergency fund would be something that should be within 6 months or 1 year. You have sufficient buffer to make sure that, let's just say, touch wood, right? If you were to lose your job or you have got a crisis that's happening at home, you do have emergency funds. So that's where cash management will be important. In the 2 to 5 year allocation, this would be something where you might need for the immediate future. So we could have friends and family deciding to pursue, let's say, a master's degree, going for further education. You do need to set money aside for that. It could happen within the next 2 to 5 years. So that would be an example. For something that's longer term, 5 to 10 years, let's just take the example of you as a family wanting to upgrade to, let's say, a bigger home. And in those instances, you would actually be saving up earlier on and making sure that you invest such that you grow that asset base, and in 5 to 10 years time you can tap on it, you can of course utilize it, but it's much better than keeping them in cash today where deposit rates are going to be around 0.05%. So that's not going to help you grow the asset pool to make sure that you can live up to the aspirations that you might have. And finally, things that are much longer term, I would say could be 10, 20 years, because that's when we're planning for retirement. And for retirement, again, we emphasize that you would be able to have a more aggressive asset allocation because you can afford to participate in the capital appreciation that can come. And capital appreciation typically will happen with stocks rather than with fixed income, which tends to provide a lower return. But of course, the trade-off is that it is more stable by nature.
Yeah, so there's always this thing that we always say at the start, we actually do savings, right? And at the end, money actually comes from investment. So that is actually the magic of, we call it compounding interest. When the longer we save, the longer we actually play in the market space and all that, the more returns we are getting, isn't it? Okay, so with that right now, should I actually aim to beat the market?
I think this is a very challenging question, I have to say, Hui Jie, because trying to beat the market would mean that you are expecting that you can always outperform. So if our Straits Time Index, as an example, STI, is going to give you, say, 5% for the full year, and you want to beat the market, so you're saying that you must generate more than 5%. So I think the big question mark here is, can you really do it? And we should look at history in order to provide the evidence to decide if we can really do that. So over here, I have put together the numbers for the US market as a proxy, but I think this is where returns have always been the strongest. In fact, Singapore may not have provided as high a return over a course of a 20-year time frame, and over here it's from 1999 to 2019. The average investor has typically been underperforming, and if you look at the chart here, you'll see that an average investor, in fact, may not even outperform inflation, and it's generating only about 1.9% per year. Whereas if you're looking at the different asset classes, be it S&P 500, having a more balanced portfolio of 60% equities and 40% fixed income, or even just investing into bonds, right? Bonds will give you 5%. So the problem there that we see is, why would an average investor underperform even through a long period of time? And that's because of an aspect around behavioral finance.
Yeah.
It's very interesting, but we do see that there's always a lot of panic selling during downturns.
Yep.
But yet when market is at the peak, there is overbuying.
Correct.
So that's a phenomenon that always happens, and despite being highly self-aware, there will be investors that can succumb to it. Mm-hmm. So I think it's important to have that discipline. You must make sure that you don't succumb to some of the herd mentality that's going around. And honestly, it's very hard to outperform the market. It's only in instances where, okay, you hear stories where people say that they picked the best stock and they made a huge amount of money, right? But for every one story you hear, I'm almost certain that there are 100 stories where people fail to make positive returns, but they all keep quiet. They don't tell you, right?
Yeah.
They only tell you the ones that
they make
is
money.
Glorifying.
Because we are still in Asia, right? We like to just boast about things that do well. Things that doesn't do well, we kind of tend to be shy to share, right? Okay, but anyway, nothing is good or bad. Sometimes when we share, the more we pain and we feel pain, the more people will share their sad stories, sob stories as well. That's where we actually kind of learn better. So actually, there's one thing to say that don't try to time the market. You're not smart, right? So how do you define this term? And I think that there's some statistics going on over here.
Right.
Can you share with us, please?
Yeah, sure. So I think the point is not about avoiding investing, okay? The point here is that you have to stay invested. Don't try to time the market. The problem where an average investor tends to underperform is because they tend to move in and out of the market. They tend to choose days when they think that you can sell at the peak, and then after that they buy back, hopefully when the market has declined. So things don't naturally work out that way, and none of us do have the crystal ball. We can't predict if this is the best day or the worst day, right? But what I'm trying to show you here is that over a long time frame, and this is actually about 50 years that we've collected the data, assuming that you move in and out of the market so much and you miss the 25 best trading days in the market, you're going to be losing significantly a lot more compared to just being disciplined, being very focused and staying invested. So if you had stayed invested for the first $1,000 that you have put into the market in 1970, by the end of 2020, you would have achieved over 120,000. So as you rightly pointed out, Hui Jie, the compounding effect is tremendous if you allow the money to do its work. Versus if you decide, no, I want to be smarter, I want to move in and out. Once you miss some of the best trading days, you can see that the differential is fantastic. It's up to around 94,000 difference.
Yeah.
So as we always say, don't try to be gay kiang, right? Let's just be very focused.
Yes. I actually agree with that because I did got burned before in stocks. You know, very kiang lah. Last time when we were young, right? Well, I make this money, I did these sales and all that. Okay, this is just my, commission. I'll give it a try. Every time we always make this mistake where we go and buy things that people say that the price is going higher and higher. But when we step in, usually it's always like +3. There's this +3 principle in stock investment and all that. The price that you buy is always already much higher when you enter. And when people start seeing the price got to stop and drop and all that, yes, panic selling. That's what I did as well, and I burned about 5 figures just on stock market. And ever since then, there's actually a lot of analyzing things that we have started to learn and stuff like that. But it's very thankful. Actually, right now, I was actually telling some of my peers that, wow, you guys are so lucky. Now you guys invest. You don't need to do anything. Just close your eyes. Send your money to Endowus. They manage everything for you, and you do nothing. You just wait for the money to come, the so-called dividend to come, right? It's like angkong and also called ang pao coming to you every single month without you doing anything, any analyzing, no monitoring at all. That's indeed a very fabulous thing. So right here, let's take a look at the second chart as well. Over here, we talk about things like not market timing, time in the markets. So share with us some of the important timing that is on the chart here.
Right. So I think over here, again, the time frame is very long. We go back to the 1970s and we have generated returns up till 2021, right, which is currently in April. And what I wanted to share with you in terms of takeaway is that very often, even if you think that, hey, I'm not going to be able to pick the best time to invest and I could be the worst market timer out there, right? So should I really get into the market? You should still get into the market because what we have shown here is that assuming that you had consistently invested 100,000 whenever the market was at the peak, and somehow you're so unfortunate that when after you buy the market starts to decline.
Yeah.
What is going to happen to you after all this time? In fact, regardless of whether you choose to invest at the peak or not, ultimately, your asset base is going to grow. So for that 100,000 that you have invested over the years, and every time you choose the wrong time, you can still end up very well in retirement with over 8 million, almost, right? 7.9 million, you'll be very comfortable at retirement.
Hang on. How much to put in and get $1 million again? I just got starting with $1 million. So can you repeat again?
I think seriously, it's not about the quantum. I think achieving $1 million is of course something that all of us would aspire to do. But I think it's about making sure that you're not affected about market timing. And where we want to advocate and also encourage our investors is to make sure that you stay invested, right? Because trying to enter and exit the market is the last strategy that you should ever do. You should just let that compounding work its magic.
Yep.
And effectively be there for the long term. So I cannot emphasize enough that investment horizon is really important. Once you have decided how to allocate and bucket out the different goals that you have and how best to segregate the different pools of asset base that can be used for investing, then I think you'll be off to a very good start.
I think when we talk about compounding interest, we also like to share with our audience this thing called the dollar cost average theory, right? So what is this theory all about?
So, Hui Jie, I think what you're trying to allude to is dollar cost averaging. And dollar cost averaging is a concept that advocates that you should try to do recurring investment, meaning that because we don't know better whether this is the best time to be in the market. But every time, let's say you're generating income because you have a salary, you can apportion a part of it and gradually keep on investing into the market. So you sort of average out your cost of entry. So let's just have a numerical example. Assuming that I'm able to set aside $1,000 from my earned income every month. So from my salary, I take out $1,000, I put it aside. So every month, I will consistently put this $1,000 into buying investments. Could be in the stock market, it could be buying bond mutual funds. Whichever it is doesn't really matter. You choose something that works for you. You will see that over time you are averaging in. So you are neither buying at the top nor buying at the bottom.
Yeah.
And this strategy based on academic research does work. It works well, especially if you have recurring income, you can make sure that you're allocating consistently. So I think that's something that's worthwhile considering.
Cool. All right. So, in fact, we should start educating our general public the 50, 30, 20 rule. Some part of it into normal investment, some part of it into savings. But right here, I do have another quite commonly asked question. Is investing in certain countries and region better than the others? You know what happened? Recently, I have this friend, aka client, who's asking me that, hey, I'm thinking to look into European markets because, US stocks and all that do charge me a very high fee. I want to look into Europe. And at the same time, I realized that European funds are better. So I just want to ignore Singapore, SGX. I want to ignore US. I just want to look at Europe. Is that the right way to do things, or what should we do as a newbie investor?
I think a lot of times either we are impacted by the fees that could be present when it comes to transaction, or it could be because of news headlines that's coming out, right? To the extent that you get attracted by certain sectors as well as countries that looks to be recovering a lot faster. And even right now, I do have queries like, for example, because the COVID-19 vaccination rate is faster in the US as well as in the UK, should we go into those markets because they might recover faster? So it's very much aligned with how your client is looking at the market. And I think what is most important is to look at some empirical evidence. So historically, if we look at how different asset classes have performed. And over here, you can see anything from US stocks to international markets as well as government bonds. And each of them are color-coded. And the point that you should take away is that across all these years, it's almost impossible for a particular asset class or even country and sector to consistently be at the top or even at the bottom. So there will be people who would expect that, hey, if I choose last year's winner may turn out to be this year's winner as well. Or even last year's winner might suddenly become this year's loser, and I take a contrarian view. But you cannot see this kind of trend. And this color chart, it's telling you that it is highly random. There's no way you can see a pattern. And in fact, if we look at developed markets, which is on the next page, developed markets tell you the same story. You will not be able to know which is the best developed market across all the different equity indices and stock markets out there. You see that the color is everywhere. And the same can be said for developing markets. Developing markets will show you the same trend. And you will see that the colors are slightly different, looks a bit brighter. But nonetheless, the key thing for you to identify here is that whether you feel that developed markets are offering more information, more transparency, and emerging markets could be slightly more opaque, doesn't really matter. At the end of the day, this randomness of returns is prevalent. And I would say that to answer your question, is it possible to pick the best market for 2021? I really don't think so. It ain't going to happen.
And frankly, if you look at last year, we're talking about, there's a Lion Global Fund on India, right? And just this year, do you see some of the returns? It's like coming down just because of India going into the second or the third wave. God knows how many more waves that's coming up. So everyone talks about India as a very good emerging market to invest into. Some of my unit trusts has done pretty well for Indian market, but suddenly it just came down, and just because of pandemic. So there's no way that we can time the market. So how about another question right here that I would like to also ask, about this thing, which is, what are some of the things to keep in mind when building my investment strategy? Is there a strategy that I talk about? Because I'm such a new investor, if I'm standing at the point of view and all that, I totally have no clue. How do I build a new strategy? Yeah.
So I think strategy, it's probably considered a more difficult term to appreciate. But having said that, to simplify it, I would consider it also a roadmap. You need to have a plan. And I think to have a plan, we can look at a couple of things. You need to be holistic, and to a large extent, I would suggest also being more scientific, meaning that you do make sure that you are systematic about how to go about doing it. So first of all, there is one school of thought, which is about looking at your priorities. And your priorities could mean your values. What do you think would be important for you as a person? Do you have a certain philosophy that you believe works for you as an individual? And right now I see many of my younger friends, they do believe a lot in ESG because you want to do good, you want to create a positive social impact, and also as an individual, you want to make a difference. You want to make sure that your money is allocated to help to improve ESG goals. To a large extent, because you are investing, companies themselves will also start changing. Many of them are reducing carbon emissions, as an example. And you are driving the cause that you believed in. So this is something that could start off as a value that can help you decide on how you want to invest. The second one is, of course, in terms of your own financial goals, right? And you want to be a lot more pragmatic in terms of deciding what would be most important for you. So, Hui Jie, maybe in 5 years' time, you could say that, hey, I want to buy a bigger apartment. And that would be a priority for you. While in other cases, we could think about also saving up for the next holiday, or even bigger goals when it comes to family planning. So many of these things, you can't have a plan. It could happen 5-10 years down the road, but at least you drive your investments to suit your timeline. The second school of thought then is on liabilities. So for individuals who today may already have certain liabilities that they need to cater for. So as an example, I think many of us do have a mortgage. We do need to pay for our installments, and there are mortgage payments that come in every month, right? So personally, I would like to have an investment portfolio that can help me cover my monthly mortgage installments. Because in a way, I have less pressure. Even if you're funding some of it by CPF and some of it out of cash, you want to make sure that you don't have a point in time where you find that you might be short on cash, and therefore you have a challenge of making that mortgage payment. So why not let the investment portfolio generate the investment income that can pay for it? So that's one form of liability. It could also be education for the children. And you do need to set aside a lump sum, right? And you know it's happening in 5 years' time. You could have your son or your daughter going to college. You do need to make sure that you can fund for their education. So liabilities is something that I think is very close to our hearts. We sort of know what are the things that we need to plan for. But I think once you set out your time frame and you know exactly how much you need to cover in terms of cash flow for those future needs, the better off you will be when it comes to having your broad-based investment strategy.
Actually, that part really strikes me. Just to share, I'm basically paying a certain amount towards a certain rental that I'm having right now. I did, in fact, since last year, when the market is at the lowest, at March last year, build a pot of a unit trust that give monthly dividend, and indeed it's actually good enough to cover it, which is 4 to 6%. And that's a real case. I mean, for friends, if you really want to know about my own investment journey, we do have one series that's covering a personal investment journey showcase, which I can actually also join my speakers to do a certain showcase as well. And all these things are really, really real things that's happening. Just now when Wei Mei talk about it, I just strike it out and I'm like, okay, I better share to all my friends here. And these are really things that we are currently building, just a pot of gold, putting somewhere to generate you this regular passive income for you to pay for some of your existing item. And in fact, right now, I'm not paying rental.
Fantastic.
Fantastic.
Yeah. Great stuff.
All right, let's move on to the next thing.
So I think the other thing about having an investment strategy is also making sure that you know what you can control and what you cannot control. Because oftentimes I do hear feedback like, I'm really frustrated when it comes to investing because there are some things that I feel that I have no control of and therefore it's affecting me on an emotional level and makes it harder to remain invested in the markets. So I think what you can decipher here would be to be fully self-aware of things that you can control. So first of all, you can control your career to some extent. I'm quite sure it cannot be 100% of the time, but you do have ability to control your income that's being generated. You can control your asset allocation mix and your diversification in the portfolio. And of course, how much you pay when it comes to deciding the costs associated with investing. Because one thing that I want to emphasize, and Hui Jie, you reminded me about the possibility of lowering investment costs, right?
Yeah.
If you can save 1% in the cost of investing every year, meaning that you lower your transaction costs, over a 30-year time frame, your compounded returns will increase by 240%. And I think that's staggering. Just 1% every year can allow you to return more than 240 times.
Yeah.
What you would have foregone if you had paid out more in terms of transaction costs as well as fees. But on the other hand, I think it's also important to take note that there are things that you cannot control, be it the broad economy, be it in terms of the returns that you're getting, as well as the fluctuations and the movements for specific stocks. These are things that there could be some idiosyncratic risk. It could be because of issues that we see with the pandemic. There's certainly no way for us to be able to anticipate. So for those things, please do not beat yourself up. It's not something that you would be able to forecast. So with that, I think you can remain chill, just stay in the market and let the money compound by itself.
Great, and that's the best way to go into Endowus, right? Yeah, we'll talk about Endowus in the next few moments time. But anyway, let's continue on to the investing 101 thing. A lot of people say that what is asset allocation? I think we touched on the 5 pillars already. And diversification. Why are they so important to diversify? We always say things like, don't put all eggs in one basket. So how many baskets do I really need?
I think at the end of the day, the baskets that you have will be aligned to your goals. And these are goals that are personal to you. It could be about funding your liabilities. It could be about retirement, right? But asset allocation is an important concept. All investment portfolios should have an asset allocation. And I want to emphasize this point on the importance of making sure that you have a strategic asset allocation. Why do we call it strategic? Because it is for the long term. It is a policy that you put together and you want to make sure that you remain invested in the same way as long as your goals remain consistent. So if we look at some of the academic research out there, they have proven that the expected returns that you want to derive from your portfolio, say for Hui Jie, she wanted to get anything between 4 to 6% with her unit trust portfolio. So with that, you will see that her asset allocation, meaning that how she decides what kind of unit trust to buy, could be fixed income, could be equities, right? But she decided that at the onset. This is going to drive 75% of her expected return. So let's just assume that Hui Jie got it wrong on day one. Okay, she just decided that to get 4 to 6%, she's just going to put deposits and stay in cash. If she actually did that, she's not going to get to 4 to 6%, right? Because there's a misalignment in terms of the expected returns. So you need to get this baseline correct. And this is going to help you be more successful in predicting your future returns that way. The other aspect which many people like to focus on would be on, first of all, security selection. Let's just say I like Tesla a lot, right? Because I like Elon Musk, so I buy Tesla. Security selection is not going to drive a lot of your returns. You may get lucky, you may also get it wrong. And academic research has proven to you that be it security selection, market timing, or even tactical asset allocation, where you suddenly decide to go overweight on equities because you just feel it's the right time, right? All these things, if you are lucky, it can help you create extra returns, but the probability of that happening is not very high. It can drive returns about 25% of the time. So if you ask me, I much rather ensure that I get my strategic asset allocation correct, because this is going to increase my probability of success. So that's why we keep saying that asset allocation is something that you look at regardless of what kind of goals and portfolio. Just make sure that if you want 4 to 6%, you know that it's most likely going to be a balanced portfolio that you look at. You need to have both stock and bonds. You can't just be holding cash.
Yes, that's true. So anyway, there are a few types of terminologies like balance, high risk takers and all that. We will come to that in some other sessions. But right now, let's also take a look at some of the things that we talk about, the importance of diversification. And should I save up money in terms of how much of pot of gold should I be saving before I start?
Right. So on diversification, maybe let me just quickly make the point there, because if you ask me if there's a free lunch when it comes to investing, and all of us like free lunches, right?
Well, I love free dinner. Not lunch. Dinner is better. I can go with wine and all that.
Cool. So let's just say free dinners, okay? Free dinners actually can come about with diversification. And we always say that if you want anything free when it comes to investing, make sure you're diversified, because that's the only thing that doesn't really come with extra costs. And over here, the research that we've put together from fund managers that we've partnered with has shown that if you can invest more broadly, from let's say 50 names to 500 names and even the broad market in general, your probability of success of replicating the market returns and showing outperformance is going to be higher. And of course, time frame matters. Over 1, 3, and 5 years, your probability of success increases a lot more over 5 years. But that's also because you have been able to cover a wider ground. You're not concentrated in any particular individual security, and that's where you would also be more well protected when it comes to situations like defaults or some companies just not doing very well because the industry dynamics have changed. So these are things to look out for, and I think be it a free lunch or free dinner, this is something that you really need to do when it comes to diversification.
Yeah, so with that, then you will get a lot of pot of gold, dividends to get your free lunch and dinner. Yeah, so there's actually this blind spot that some of my friends actually say that, oh, I need to save up more money first. Only a few $1,000s, I want to save up like 10,000, 20,000, then I start investing. Is that right or wrong?
From my perspective, I think when it comes to investing, there's no amount that would be too small. Even today, we advocate that investors should start from as low as $1,000. The reason why I say that is because just looking at numbers, and if we look at an example, we have 3 individuals here. I've named them Buttercup, Blossom, and also Bubbles. So each of them started investing at a different age, right? Buttercup was the earliest. She started at 25, Blossom at 35, and Bubbles at 45. So even though you would see that Buttercup and Blossom started with a smaller amount compared to Bubbles, eventually, because they started younger, the compounding effect was beneficial for them. And at the end of the day, Buttercup, because she started the earliest, and even though she didn't have the largest investment amount to start with, she would have accumulated a lot more assets by the time she gets to retirement. So what we are saying here is that it's important to get started. I would suggest that no amount is too small. If you have $1,000 today that you're keeping in DBS Bank or in POSB, I think many of us in our generation always had a POSB account, right? I remember going to the bank and I loved the squirrel. So that was something that attracted me. So I saved up a lot, right? But having said that, if I had even started investing perhaps when I was 12, right, and not 21, I would have already made significant, made my assets grow significantly during this period of time. So this is a key takeaway, and I would encourage everyone to start younger. It's never too early. You can start your children on their investment journey.
Actually, I beg to differ. Nowadays, the kids are really learning. You know what? I actually was conducting a workshop for a family investment course, and we literally got the kids to log into their parents' CPF account. Yeah.
Wow.
Yeah, and they learn, oh, this is CPF and what is CPF all about, and what can I do with CPF, and they even learn about things like CPFIS, the investment account and stuff like that. So I think things might change in the future. Maybe 12 years old, you're legal to actually start investing.
Well, that would be fantastic, right? You're starting financial literacy at a much younger age
Younger
right
age,
now.
yes. All right, so every single time as well, right, when we talk about brokerage, going through like third party, people will say that, what? Endowus, no, I do myself, because they should be very expensive. So what kind of fees are we talking about, and why is there so much of fees? Like the banks are charging like between 3 to 5% for management fee. Some of them charge like 4%, 2% for platform fee. Some of the financial advisors charge like 2 to 3% for rep fee. So what kind of fees are there in the market? Why are there so many different types? And how is Endowus positioning yourself?
Yeah, so Hui Jie, to your question, I think it's important for our audience to also get a sense of the different terminology that's used, just so that we are helping everyone to understand what are the different fees in the market, right? So if we just look at the comparison, today, if you were to walk into the bank, I want to share with you that the mutual funds or the unit trust that you are assessing is always going to be the retail share class. Meaning that the management fees are higher because the denomination that you're buying are typically in smaller sizes. And also the fund managers charge a higher fee when they are providing the solution to retail investors compared to institutional investors. And institutional investors, I would give you an example. This would be the likes of our GIC, our Temasek. So in Singapore, this would be classified as institutional investors, right? So how do we get institutional access to the same kind of solutions and make sure that you are paying the same kind of low fees that the likes of a GIC as well as Temasek are assessing? So this is where we come into the picture, where we are negotiating on your behalf and we are able to provide access to the institutional share classes of unit trusts. If you just compare the fees and you see it on the graph right now, the difference between an institutional fund fee as well as a retail fund fee is huge, right? It can be typically a 1% difference. And for that matter, you can already save about 1% if you use an institutional share class. So always try to make sure that if you are looking at selection of unit trusts and mutual funds out there, ask for the institutional share class, and if you cannot get it anywhere else, which I'm sure you cannot, come to Endowus. And the other thing that you need to take note is if you walk into a retail bank today, your RM will charge you an upfront fee. There's a sales charge. You need to pay the bank in order to buy the fund. And that's where
sell the fund as well.
Exactly. So it's subscription and also redemption. And
Correct.
that's a huge amount, right?
Yes.
I've had many of my investors come to me and say that I pay anything up to 3-4%.
That's common. Sometimes
That's
5%.
common, right? Yeah, 5%, you've heard of it as well. So it's really high. You just need to be fully aware. For us at Endowus, we don't charge any subscription or redemption fee at all. So that lowers the cost even more for you. The only thing that we would charge would be an access fee. The access fee would be effectively for us to bring you the solutions. We are doing the due diligence and the research. We are also monitoring on your behalf. So we do have what we call an access fee, and that can be anything from 0.05% up to 0.6%, depending on whether you're looking at a cash management solution or you're looking at, for example, CPF and SRS, which is at 0.4%, and of course, for cash investing, starting at $1,000 is at 0.6%. But all in all, you can tell that in terms of overall fees, we are the lowest in the market, and I would say that it's highly competitive, especially when you are able to assess some of the best managers out there in the market, which even if you were to go to other providers out there, you will realize that they are retail share classes. So for your overall total expense when it comes to assessing the funds, it's going to be very far more higher compared to if you were to do it with us. So these are some of the names that you see right now that we partner with. We have about 30 managers that we're collaborating with right now, and we're continuing to increase our access to help our investor base to have a far more wide-ranging selection, and also make sure that we are tapping on the expertise of many of the giants out there in the market who are expert in their own areas.
Yeah, and I think the team is pretty strong as well. Yeah, all of you come from investment banking background.
Yes, so I'm very proud to say that all my fellow team members as well as colleagues, we all come from an investment background, and to a large extent, we have been looking at how to utilize technology to best serve our growing client base. So if you look at the credentials of our team, I would mention that for Sam Ree, who is our chairman and CIO, he was previously the CEO and also CIO at Morgan Stanley Investment Management. Gregory Van, who is our CEO, was previously from UBS Investment Bank and also Grab. And our other colleagues have come from Goldman, as well as the likes of Nomura, Morgan Stanley, and even some of the tech organizations like Lazada and also ByteDance and Lyft. So I think very familiar household names that many of you are aware of. So I'm certainly very excited to be a part of this team. And as we go about helping to solve the pain point for our investors in Singapore, we truly want to ensure that we can go on this journey together. And today, we actually have got a promo code that has been put together. So if you were to join us on this investment journey, there's now a 50% off assessed fee until 31st of December this year. So I think this is a fantastic opportunity, and I'll urge you to scan the QR code and check out our website.
Yeah, and I believe that Endowus will be back again to share with us more about more insights like the funds. We're actually also very interested to know, how do you start it? I recall that your first partner is UOB Asset Management, right? Yeah, and how do you all move on from UOB, then next to CPF, and up next to S&P 500 and ESG, the HIT, and one of the most commonly talked investment type, which is called ESG itself. So do stay tuned on this show itself, where we'd like to bring you more quality content in terms of money mastery. Okay, and with that, we come to the last few slides, which are all the questions. So the quiz number 1 is actually here. What is the best region to invest in for 22-1? So you can always hit your answer into the email or the chat box here. You have 3 days to do that. Not to worry, you don't have to rush right now. And also, a lot of friends usually tune in much later on, so we do value your participation. Okay, so do tune in the next few days as well to actually answer all these quiz questions. And the second one right here is, how do you best protect yourself from all these type of different type of market classes and all that? When investing, what do you do? Do you diversify, or do you buy Apple shares, put into your bank account, or buying gold? I think we're just giving them the answer, isn't it?
They have to listen hard.
Yeah, you can back tune again, yeah? And the last one, I think this is something quite easy to be answered. What can you invest through Endowus? And I think the answers are all there, okay? So right here with that, we come to the last slide for today. So Wei Mei, I just want you to give us like a wrap up on this whole journey in terms of Wisdom Eye on Business, money mastery. What do you feel that we can do better in terms of managing our money and our cash itself?
I think if I were to give a final word of advice, if I may, to our audience who is listening in, I think the important thing when it comes to investing is to make sure that you have a high level of self-awareness. You know that you should be disciplined, and you're not affected by many of the news headlines out there. Because I think making sure that you remain in the market and you're allowing your assets to grow because of compounding and making sure that you are also doing recurring investment by deploying more of your salary into your investment portfolio would be the right thing to do. So with that, I wish everyone a very good evening and thank you for joining us.
Yes, so thank you so much for our guest right here, and of course feel free to drop us an email if you have any question. If not, we will actually be signing off and we will see you in the next show. Thank you and good night.